Right now, there is a situation developing that most people in the Fraser Valley are not paying close attention to. Oil prices just surged more than 50% in the matter of weeks. And the last time something like this happened, it triggered one of the fastest interest rate cycles in Canadian history, one that nearly froze the real estate market. So, the question I want to ask today is this: are we heading into something similar? And what does that mean if you are buying, selling, or holding properties right now in Surrey, Langley, or anywhere in the Fraser Valley? Hi, my name is Roshan Victor. I'm a real estate professional working in this particular market. And this is a topic that every homeowner and buyer needs to understand before they make any decisions related to their real estate. So let's get into it. Most people think of oil prices as a gas station problem. You fill up, it costs you more, you're annoyed, and you move on. But what's actually happening right now goes a lot deeper than that. It connects directly to the price of your mortgage. Here's how the chain works: when all prices spike, it does not just raise the price of gas, it raises the cost of transporting goods, manufacturing products, and shipping food. Everything that moves or gets made becomes more expensive. That's called inflation. And right now, because of the conflict involving US, Israel, and Iran, roughly 20% of the world's oil supply has been thrown into uncertainty. Benchmark oil prices have risen more than 50% in just the matter of weeks. And the average price of gas in Canada has already jumped nearly 40 cents per litre. Before all of this started, Canada was actually in a pretty good spot on inflation. February inflation readings came in at 1.8% year over year. That is below the Bank of Canada's 2% target. We were heading in the right direction. But here's the problem: these numbers were measured before the oil shock fully kicked in. Economists are already projecting that headline inflation could climb to around 3% in just a matter of months. 3% sounds manageable, right? And compared to 2022, where the inflation hit high 8%, it is definitely manageable. But it's still moving in the wrong direction. And the key question is not where inflation starts, it's whether it spreads or not. Bank of Canada is now worried about the immediate jump in gas prices. What they are watching is whether high energy costs start percolating into food, transportation, wages, and whether it borders cost of living. If it stays contained, they may hold steady. If it spread, everything changes. And Bank of Canada just held its overnight rate at 2.25% for the third meeting in a row. On the surface, that sounds like stability. Nothing changed, no hikes, no cuts. But here's the part most people are missing. Governor McLean described the current momentum as a dilemma. Rising interest rates to slow inflation could further weaken the economy, but easing interest rates to support growth risks putting inflation well above target. That is not a comfortable place to be. And the economy they're trying to protect is already showing cracks. Canada lost 84,000 jobs in February. GDP contracted in the fourth quarter of 2025. Unemployment is sitting at 6.7%. So we have a weakening economy on one side and rising inflation risks on the other. This is called stagflation, and it is one of the hardest situations for a central bank to face. Before the oil shock, the Bank of Canada was widely expected to stay on hold through all of 2026. Now, financial markets are pricing in the possibility of a rate hike in the back half of the year. And that matters because even the expectation of a rate hike changes how people behave. Buyers are cautious, lenders get careful, and the bond market starts moving before the Bank of Canada can make a decision. I want to slow down here because this is one of the most misunderstood part of the whole story. When people hear about interest rates, they usually only think of what the Bank of Canada does. They hold, they cut, they hike. That becomes the headlines. But there are actually two separate forces that drive the mortgage rates you pay. First is the overnight rate. That is what the Bank of Canada controls. When they raise or lower it, variable rates follow quickly. If you have a variable rate mortgage and the bank hikes the overnight lending rate, your payments go up. That part most people understand. The second force is bond yields. And this one is already moving right now, whether the Bank of Canada hikes or it does not. Here's how it works. The Canadian government issues bonds. When you buy a government bond, you are lending money to the government and they pay you interest. The rate they pay you is called yields. When the investor expects more inflation or more risk in the economy, they demand higher yields to compensate. And when those yields go up, fixed mortgage rates follow. Now, the Bank of Canada 5-year bond yield is the benchmark that lenders use to price fixed mortgages. In recent weeks, it has risen more than 60 basis points. It just surpassed the 3.2% level, and lenders are already responding. Some have raised their 3 and 5-year fixed rates by up to 30 basis points. The best insured 5-year fixed rate is now sitting around 3.89%. It is up from 3.79% just last month. And the big six banks have not yet fully adjusted. More increases are likely coming. That might seem like a small number, but in a market where the buyers are already stretching to qualify, even a small move in fixed rates reduces purchasing power. It shrinks what they call affordability, and it pushes some buyers back into waiting mode. Let me give you a real picture of where Fraser Valley sits today. 2025 was the slowest year for home sales in this market since the year 2000. Fraser Valley Real Estate Board recorded 12,224 sales last year. That is down 16% from 2024 and a 33% below the 10-year average. Think about what that means. Prices have come down, inventory was at the highest level in 40 years. Buyers have more choice and more negotiating power than they have had in decades, and still, sales hit a 25-year low. Benchmark price for a typical home in the Fraser Valley ended 2025 at around 905,900. That was down 6% from the year before and 24% below the peak we hit in March 2025. And it has kept sliding into 2026. As of February, the composite benchmark price dropped to 895,100. That is the 10th straight month decline. And we are now approaching pandemic era 2021 pricing levels. Detached homes in Surrey are down 8.6% year over year. Townhouses down 7.1% and condos down 8%. Active listings are sitting at over 8,300 homes. That is 51% above the 10-year seasonal average. This is a buyer's market. There is no doubt about it. And this spring was supposed to be the beginning of recovery, as a lot of pundits predicted. Rate cuts had come through, prices had corrected significantly, and people were starting to come off the sidelines. And then oil price spikes because of the conflict in the Middle East. Let me be direct about this. This is not a repeat of 2022. Not exactly. In 2022, inflation hit 8%. The Bank of Canada was sitting at a nearly zero. The Bank of Canada was sitting at a near zero rate and had to raise aggressively. 9 rate hikes from 0.25% to 5% in a very short period. That was a shock the market had never experienced before. The situation today is different. Inflation was near target before this started. The overnight rate is already at a neutral level, and the oil shock, while real, is not guaranteed to persist. And here's the other side of that. In 2022, the market was crashing from a peak. There was room to fall. Today, the market is already on the floor. We are already 24% below 2022 peak here in the Fraser Valley, and prices have been falling for 10 consecutive months. Buyers are uncertain, sellers are frustrated. If the rate goes up from here, even slightly on a market that is already this fragile, you do not need another 2022 to cause real damage. What you get instead is a long, slow, and a painful recovery. Continued slow sales through what should have been a strong spring, investors staying on the sideline even longer. The issue is a market that was already struggling, getting one more thing pushing it in the wrong direction. And what does this all mean for you? Let's talk about what to actually do with this information. If you're a buyer right now, this matters more than you might think. Fixed rates are already moving up. If you have been thinking about getting pre approved, doing so sooner rather than later, locking in a rate while they are still relatively low, is a better choice. Every fraction of a percent you add to your rate reduces what you qualify for. And right now, you still have inventory, you still have negotiating power, and you still have time to make a considered decision. So, locking in a rate will give you 90 days to actually explore the market. But that window could get smaller if the rate continues to move in the wrong direction. If you're a seller, this is a message to price honestly. The buyers who are active in this market right now are informed, they are patient, and they know inventory numbers. They know they have leverage. The homes that are moving are the ones priced to match where the market actually is today, not where it was 2 to 3 years ago or even 2 months ago. Overpriced listings are sitting, well priced listings are moving. And if you are an investor, keep your eyes on the bond market, not just the Bank of Canada headlines. Fixed rates are already repricing. If yields stay elevated, that affects your cash flow, your cap rate, and the psychology of buyers you will eventually need to sell to. And here's where I actually stand with this information. Canada's economy was already fragile coming into this. Trade uncertainties, job losses, slow growth, and now we have an oil shock layered on top of all of that. Bank of Canada is watching very carefully. They have held their rate. They may continue to hold, but the bond market does not wait for Bank of Canada. It moves ahead and fixed mortgages are already reacting. Governor McLean put it plainly. If the energy prices stay high and inflation starts to spread, the bank will raise rates to cool things down. If the prices come back down and the economy stays weak, they will cut to add support. Two very different outcomes, both are possible. Best case, the conflict de escalates, oil prices pull back, rates hold or fall, and the spring market finds some footing here in the Fraser Valley. The hardest case, the oil prices persist, inflation pushes past 3%, bond yields stay elevated, and the market that we are already struggling faces more headwind. We do not know which path this takes. What we do know is that the window of soft pricing and relatively low rates that buyers have been waiting for could narrow faster than anyone expected. If you are sitting in Surrey, Langley, Cloverdale, South Surrey, or anywhere in the Fraser Valley right now, and you are trying to figure out what this means for your situation, I would love to have that conversation. Whether you are thinking of buying, thinking of selling, or just thinking to understand what your home is worth in this particular environment, reach out. My contact information is right below in the descriptions. And if you found this helpful, please do subscribe to the channel. I'm going to keep covering how this oil situation, the bond market, and the Bank of Canada's next move are affecting real estate right now in our backyard. We will keep watching this together. See you in the next video.